Ever wonder what it would be like to get the real inside story on a company? I mean, not just the headlines, but the crucial strategic moves, the financial surprises, and how they actually run things.
Yeah, the stuff that really matters.
Exactly. Well, today we're doing just that. We're diving deep into Kingsway Financial Services, Inc., or KFS.
KFS.
And this isn't your average holding company. They've carved out a really fascinating niche with what they call their entrepreneurship through acquisition model.
Right, the ETA model. And for this deep dive, we've pulled together a stack of their recent SEC filings, investor presentations, even some YouTube transcripts.
So good mix of source.
A solid mix. Our mission here is to unpack KFS's unique dual growth strategy, try to demystify its financial landscape a bit, and highlight some key governance details.
Okay.
By the end, you should have a pretty comprehensive understanding of what truly drives this distinctive company and maybe a richer perspective on a somewhat unconventional business approach.
Sounds good. So let's peel back the layers. Start with KFS at a glance.
Let's do it. It's a Delaware incorporated holding company listed on the NYSE, ticker KFS. Pretty straightforward there.
Yep.
They operate through two main segments now. The more established extended warranty business, and then their, let's say, exciting growth engine, the Kingsway Search Accelerator, or KSX.
KSX, got it. And wasn't there another segment?
Yeah, good point. They had a leased real estate segment, but that was discontinued in late 2022. So really focused on these two now.
Okay. And their core strategy, you said it was compelling.
It really is. They're built on these dual engines of growth. So they're actively acquiring new companies and then working hard to expand the earnings of the ones they already own.
So buy and build.
Precisely. It's a powerful combination, and they're quite specific about their targets, aiming for about 2 to 3 acquisitions per year.
Okay.
And they set a, frankly, impressive 30% internal rate of return, IRR, as their hurdle. That's a high bar.
30%. Wow.
Mhm.
How are they doing against that? What are the numbers looking like?
Well, as of May 2025, their run rate adjusted EBITDA, earnings before interest, taxes, depreciation, amortization, basically a good measure of operational profitability, it stands around $18 to $19 million over the last 12 months.
Okay, so generating solid cash flow.
Yeah, it tells us they're not just growing the top line, but they seem to be growing profitably.
Okay, so that's the setup. Now let's talk about the heart of their strategy, this search fund or entrepreneurship through acquisition model. You said it solves a problem.
It really does, and it's quite brilliant because it tackles a really common, often quite emotional problem.
Which is?
Well, on one side, you have this huge demographic of aging small business owners. They're looking to retire.
Right, the baby boomer exit wave we hear about.
Exactly. And many of them lack a clear succession plan. Maybe no family member wants to take over. They aren't finding attractive buyers.
Or the buyers they do find want to break things up or change everything.
Precisely. And they often worry deeply about how selling their life's work might impact their employees, their legacy. Plus, these businesses are often too small for traditional private equity, but too big to just close up shop.
That's a tough spot. A huge concern for founders who've poured decades into these businesses.
Yeah.
The idea of just cashing out without a plan for their people or their brand.
Yeah.
Yeah, that can be heartbreaking.
Absolutely. Then, on the other side, you have this surge of highly motivated, often post-MBA entrepreneurs, super smart, driven.
Eager to run something.
Yeah, eager to lead and grow a company, but they might not have the capital to buy one outright or maybe a network to find that perfect opportunity.
Okay, so two sides of a coin.
Exactly. And the search fund model, which KFS leverages, acts as the perfect connector. It offers sellers a graceful exit, often ensuring legacy preservation.
Which is huge for them.
Huge. And it gives these ambitious entrepreneurs the chance to step in and lead a proven business. Plus, they get to participate meaningfully in the equity value they help create.
All right, so they have real skin in the game. Now, you, the listener, might be thinking, okay, search funds sound cool, but how does that connect to me as an investor?
Good question.
Well, here's what KFS presents as the game changer. Their approach is unique because investing in KFS stock is framed as an instant, liquid way to participate in a broad portfolio of these search fund acquisitions.
So you're not picking individual deals.
Right. What does this mean for you? It means you can effectively invest in the search fund model without having to, source, vet, or manage individual deals yourself.
Yeah.
And you don't have to wait through a private fund's long life cycle, which could be, 7 to 10 years?
Easily. And that's not all. As a public company, KFS also offers a level of transparency and regular reporting SEC filings, quarterly results that many private search fund investments simply lack.
Good point. More visibility.
Definitely. So it's a unique investor-friendly way to get exposure to this attractive search fund space, but with built-in liquidity, diversification, and transparency. It's essentially like they're trying to institutionalize a model that has traditionally been quite bespoke and, well, private.
That's a really compelling differentiator. Okay, so let's dig into their engine for this. The Kingsway Search Accelerator, or KSX, it seems to have a real strategic edge. What are some of those advantages?
Yeah, they highlight several things. One of the standout elements is their track record. KFS points to successful acquisitions and exits already under their belt.
It's a proof of concept.
Exactly. It provides evidence that their model works, which gives confidence they're not just theorizing, but actually executing.
And they don't just acquire and then, walk away, right?
Not at all. The key differentiator seems to be the robust infrastructure and support they provide. They give this to the companies they buy and the operators who run them. It's all thanks to their Kingsway business system.
Ah, okay. Like a playbook for success.
That's a great way to put it. Plus, they're really strategic about who they bring in. They use these proprietary C candidate scorecards.
C candidate scorecards. What's that about?
It seems to be their way to identify and segment potential leaders, focusing on specific behaviors they believe drive influence and success.
Interesting. So it's not just finding a good business.
Right. It's about finding the right leader for that business. And connecting this to the bigger picture, they also orient their operators to pursue industries with the highest potential for investment returns. They're looking for things like positive cash flow, high margins, strong industry tailwinds, the usual suspects for smart investing.
Makes sense.
And they're constantly studying deal sourcing tactics, sharing best practices with their operators, and maintaining relationships with top MBA programs to tap into that talent pool.
Where do they find most of their candidates?
What's particularly noteworthy is they say their strongest source of candidates, these exceptional entrepreneurs, comes from in-network referrals.
That speaks volumes about their reputation, right? If people within their network are recommending others.
I think so, yeah. It suggests people have had good experiences working with them.
I also appreciate that they emphasize a disciplined investment philosophy. They use the mantra, wait for the fat pitch.
Yeah, the Warren Buffett classic.
Right. It suggests their margin of safety is driven by quality and thorough diligence, not just haggling for the lowest price. They're still aiming for those 2-3 acquisitions per year, but it implies they're not rushing into bad deals just to hit a quota.
A disciplined approach.
So who are some of these key players, these operators, and what kind of acquisitions have they actually made to build out this KSX portfolio?
Okay, well, their operator in residence, or OIR, program is really KFS's talent engine for KSX.
OIR program.
Yeah. It aims for about 4 to 5 active searchers at any given time, and they're targeting acquisitions typically in the range of $1.5 million to $3.0 million in adjusted EBITDA.
So smaller end of the middle market, generally.
Generally, yeah. Think of it as a pre-vetted leadership pipeline. It seems designed to significantly de-risk the post-acquisition phase because they have these experienced operators ready to go.
Like who? Any examples?
Sure. They mention people like Rob Casper, who's leading Kingsway Skilled Trades and was involved in the Bud's Plumbing acquisition. We also see names like Drew Richard and Peter Hearn mentioned as OIRs.
Okay. And they've also brought in some serious external expertise, right? I saw mention of a strategic advisory board formed in 2022.
Yes, and it includes some really notable figures like Mr. Thorndike, the author of The Outsiders, a fantastic book on unconventional CEOs.
Oh, wow. That's a big name in value investing circles.
It is. And also Mr. Gordy, who was the former president and CEO of PWSC, a company KFS actually used to own in their warranty segment.
So deep industry and investment knowledge. That's an impressive lineup. How do figures like that actually influence their strategy day to day, do you think?
Well, you'd imagine they provide invaluable guidance, right? Leveraging their deep experience to help shape KFS's long-term vision, refine the acquisition strategy, maybe act as a sounding board.
Keeping them disciplined.
Yeah, helping ensure KFS maintains that disciplined, value-oriented approach, kind of consistent with that outsider investor philosophy Thorndike wrote about.
Makes sense. Okay, what about specific acquisitions? What companies are actually in the KSX portfolio now?
Let's look at a few. Rivix Financial Inc. and C-Suite Financial Partners were both strategic additions in the professional services space.
Great.
Rivix, acquired back in October 2021, provides outsourced financial services. And C-Suite, acquired November 2022, offers financial executive services like fractional CFOs.
So complementary businesses.
Very complementary, expanding KFS's footprint there. And interestingly, Revix's CEO, a Mr. Oka, was apparently an early member of KFS's own search accelerator program.
Oh, interesting. So they incubated him, he found a deal, and KFS backed it.
Seems like it. It really showcases that internal talent pipeline potentially working just as designed.
Cool. What else?
Then there are a couple in healthcare services. Secure Nursing Service, LLC, or SNS, acquired November 2022. They provide healthcare staffing primarily in California.
Okay, staffing. High demand area.
Definitely. And then Digital Diagnostics Imaging, Inc., or DDI, acquired October 2023. DDI offers outsourced cardiac telemetry services, basically remote heart monitoring.
Like for hospitals.
Exactly. They're now present in 39 states and Puerto Rico, and the key value proposition is that they free up hospital staff for direct patient care. That's huge in today's healthcare environment.
Yeah, staff shortages are a major issue. That sounds like a smart niche.
Seems like it. And then most recently that we saw, Systems Products International, or SPI, was acquired in September 2023.
SPI, what do they do?
This company specializes in vertical market software, specifically for shared ownership properties like timeshares or fractional ownership.
Software, recurring revenue.
Exactly. Expanding KFS's portfolio with that sticky recurring revenue and, importantly, low capital intensity. So you see, it's becoming quite a diverse portfolio, but each piece seems to fit into their broader strategic picture of finding good businesses with strong leaders in attractive niches.
That's a fascinating snapshot of how KFS is building out its entrepreneurial portfolio through KSX. Very dynamic.
Yeah, it's where a lot of the growth story is focused. But as you know, every robust company probably needs more than one engine.
Right. Stability is important too.
Exactly. So let's shift gears now and look at their other significant segment, the extended warranty businesses. This brings a different kind of stability, maybe a more predictable element, to the overall KFS picture.
Okay, right. The other engine. So tell us about that segment. What kinds of businesses are in it, and how do they function within KFS?
Sure. This is actually a more diversified portfolio within itself. It includes players like IWS. They specialize in motor vehicle service agreements, primarily sold through credit unions.
Okay, car warranties via credit unions.
Then you have Gemini and PWI doing similar work vehicle service agreements, but they work through used car dealerships and other dealer partners.
Got it.
And then there's Trinity. They offer warranties for a wider range of things, HVAC, generators, even LED lighting and commercial refrigeration, plus some equipment breakdown and maintenance support.
So a broader BDB focus there, maybe.
Seems like it. And you mentioned PWSC earlier, the home warranty service, just to reiterate. That was part of this segment, but it was sold back in July 2022.
Right, sold off. So what's the key takeaway from this warranty segment for an investor?
I think the key takeaway is that this segment provides a stable, generally cash-generative foundation. It helps balance the more dynamic, maybe higher risk, higher reward growth we see from KSX.
Okay. Now, you mentioned cash generation, but there are some operational nuances here, right? Especially around the cash flow itself. Something about restricted accounts.
Yes, exactly. This is important to understand. A significant portion of the cash these warranty businesses generate isn't immediately available to KFS corporate. It's required to be placed into restricted trust accounts.
Why is that? Is it like an insurance thing?
Pretty much. It's often a regulatory requirement or part of their agreements with insurance partners. It's there to fund future expected claims based on actuarial analyses.
Okay, so they estimate future payouts and set aside cash.
Right. Think of it as a safety net. It ensures the capital is always there to meet future warranty obligations, which makes the underlying business very stable. But it also means that a lot of that cash flow isn't immediately available for KFS to use for, say, new acquisitions or dividends.
Got it. Locked up for claims. How has this segment been performing recently?
It's a bit mixed, as you'd expect with different businesses. Looking at Q2 2024 results they mentioned, SNS, the nursing staffing company we discussed earlier, which they seem to report alongside warranty, sometimes saw flat revenue, but actually improved its gross margin and adjusted EBITDA.
Why was that?
Apparently due to a higher mix of travel nurse shifts, which tend to be more profitable.
Okay.
However, IWS, the vehicle warranty business working with credit unions, experienced some challenges back in Q2 2023. They reported a $0.3 million decrease in contribution, mainly due to increased claims costs and some customer losses.
But was it all bad news for IWS?
No, they noted it was partially offset by growth from some new and existing customers, so, puts and takes like in any operating business.
Stability, but with some moving parts. Okay, let's turn now to KFS's overall capital structure, how they fund themselves. This has seen some pretty significant activity recently, right?
It really has. They utilize preferred stock, for one thing.
Okay.
First, there's the Class B preferred stock. This carries a fixed 8% cash dividend annually. But here's a kicker, a powerful incentive for KFS to manage their cash carefully. That dividend escalates sharply to 18% if it goes unpaid for more than 2 consecutive quarters.
Wow, 18%. That's a big jump, a real penalty box.
Huge jump. These shares are also convertible into common stock at a set rate, and they're redeemable by KFS, but not until September 2031. As of June 2025, the redemption amount was about $8.3 million.
Okay, and there's another class.
Yes, just recently, in February 2025, they issued a new series, the Class C preferred stock, raising $6.0 million.
Okay, fresh capital.
Yeah. This new series ranks equally with the Class B preferred, so same priority level, and it's senior to the common shares. This issuance suggests they're continuing to strategically use preferred equity, maybe to fund growth or just manage their balance sheet.
Right. Now, what's really fascinating here, I think, is the story of their trust preferred securities, or TRUPS. Can you unpack that? It sounds complicated.
It was a bit complicated, yeah. Trumps were essentially a type of hybrid security, kind of like subordinated debt, issued out of subsidiary trusts. Their interest rates were tied to LIBOR, which, as you know, was a common benchmark, but is now being phased out.
Okay, so subordinated debt linked to LIBOR. What was the issue?
The key challenge, and something analysts definitely noted, was that KFS had been deferring the interest payments on most of these Trumps since way back in Q3 2018.
Deferring interest for years. Oof. That must have been building up.
It was. This was a notable overhang on their balance sheet, but this really highlights their active and, you could say, strategic balance sheet management recently.
What did they do?
In March 2023, KFS executed a really significant maneuver. They repurchased 5 of these Trump's instruments for a total of $56.5 million in cash.
Okay, paid them off.
Well, yes, but here's the interesting part. This repurchase actually settled obligations that consisted of $75.5 million in principal plus $23.0 million in that deferred interest we talked about.
Wait, so they paid $56.5 million to get rid of almost $98.5 million in debt and accrued interest.
Exactly. As a result, they recorded a substantial $31.6 million gain on the extinguishment of that debt.
That's huge, a $31 million gain just from cleaning up the balance sheet.
It significantly streamlined their capital structure and removed that deferred interest overhang. Now, only one Chempai's debt instrument remains outstanding. It has a $15.0 million principal amount, matures way out in May 2033.
And are they paying interest on that one?
Yes, critically, they resumed interest payments on this remaining Trumpy in March 2023, signaling a return to more normal operations on that front.
So a major deleveraging and simplification of their debt. That's a big positive step.
Definitely looks like it. Beyond the Trumpies and preferreds, they also manage several bank loans, mostly tied to their various acquisitions. You know, the 2020 KWH loan, the 2021 Revix loan, the SNS loan, and some new 2024 KWH loans.
Standard practice for acquisitions. Do these have strings attached?
Oh, yeah. Like most corporate loans, these come with covenants, basically rules they have to follow. Things like maintaining certain leverage ratios or fixed charge coverage ratios.
So the banks are keeping an eye on their financial health.
Right. And these covenants aren't just boilerplate. They do strategically limit KFS's ability to, say, take on excessive new debt or make big distributions or sell off key assets without lender approval. It forces a certain discipline and protects the lenders.
Which indirectly protects shareholders, too, you could argue.
You could. That financial discipline is key. Now, shifting slightly, but still on the financial front, their reports also reveal some impairment charges from time to time.
Impairments, like writing down the value of something.
Exactly. For instance, they noted $0.1 million in Q2 2025 related to the Ravix trade name, and $0.7 million back in Q2 2024 related to the SNS and C-Suite trade names.
Why do those happen? Business not doing as well as hoped.
Typically, yeah. These charges usually happen when the projected future cash flows or the overall economic value expected from an asset, like a brand name acquired in a deal, fall below what was initially recorded on the books. It's often triggered by lower than projected revenues or maybe higher discount rates used in the valuation.
Okay, so little adjustments reflecting performance realities. Good to know. What about the legal and accounting landscape? Anything noteworthy there?
A couple of things. First, KFS has an ongoing obligation under something called the Aegis Settlement Agreement.
Aegis settlement.
Yeah. They have to reimburse Aegis for 60% of future customs bond losses, up to a maximum total payout of $4.8 million. As of the end of 2024, they'd reimbursed $1.7 million.
Leaving about $3.1 million as potential future exposure.
Correct. So something to keep an eye on. And then on the accounting side, we mentioned KFS has a stack of U.S. net operating losses NOLs. These are valuable.
Right, past losses they can use to reduce future tax bills.
Exactly. But there's a catch governed by Section 382 of the U.S. Internal Revenue Code.
Section 382, what does that do?
It places limits on how much of those NOLs they can actually use each year, especially if there's been a significant ownership change in the company's stock.
Ah, so you can't just buy a company solely for its huge NOLs and use them all at once.
Pretty much. It's like having a big discount coupon, but the rules say you can only use a little bit of it each year. It's a common but important consideration for companies with large accumulated losses.
Got it. Anything else on the accounting front? Internal controls?
Yeah, they did disclose a material weakness in internal control over financial reporting back in 2018. It was related to handling complex and non-recurring transactions.
Okay, that sounds serious. Are they fixing it?
They stated they've been working on a remediation plan since then, and more recently, a specific cash flow statement classification error was noted in Q1 2024 related to how they accounted for that big TRUPS deferred interest repurchase.
So ongoing effort needed there.
It highlights the importance and maybe the difficulty of maintaining robust financial controls, especially with complex transactions and multiple subsidiaries.
Definitely. Okay, let's shift gears one last time to corporate governance. How the company is run, board structure, shareholder rights, stuff like that.
Sure. Their board of directors currently consists of 7 members. Terrence M. Kavanaugh serves as chairman of the board.
Okay.
And the key executives are John T. Fitzgerald, who is the president and chief executive officer. He's been in that role since September 2018. And Kent A. Hansen is the executive vice president and chief financial officer since February 2020.
Got the leadership team. Now, how does shareholder voting actually work at KFS? If I own shares, what happens?
Good question. If you, as a shareholder, receive and sign the enclosed proxy form they send out for meetings, you're authorizing either Mr. Kavanaugh or Mr. Fitzgerald to vote your shares on your behalf.
Can I write in someone else?
It's important to note you generally cannot appoint someone else via that specific form they provide. You're giving your proxy to one of those 2 named individuals.
Okay. What if I sign it but forget to check the boxes for how to vote?
If you sign the proxy but don't specify how to vote on a particular issue, your proxy holder, Mr. Kavanaugh or Mr. Fitzgerald, will vote for the board's recommendations. Typically, that means for the election of director nominees, for the ratification of auditors, and for the advisory approval of executive compensation. So default is yes to management's proposals if you don't specify.
Usually yes, but you do have options if you change your mind. You can revoke a prior proxy by submitting a new, later-dated form, or by using the internet website or toll-free number if those options are provided.
Or show up in person.
Or by attending the meeting in person and specifically declaring your prior proxy revoked before the vote happens.
Okay, good to know the mechanics. What about director elections themselves? How does that work?
Well, technically, in an uncontested election, director nominees only need a plurality of votes to be elected. That just means more votes for than anyone else, even if it's not a majority.
Sounds like a low bar.
It can be. However, KFS has adopted what they call a majority election of directors policy.
Okay, what does that policy do?
In an uncontested election, if a nominee doesn't receive a majority that's defined as 50% plus one of the votes cast FOR their election, they are required by this policy to immediately submit their resignation to the board's audit committee.
They have to offer to resign.
Yes. Then the board, acting on the audit committee's recommendation, has 90 days to decide whether to accept or reject that resignation.
Interesting. So it adds more accountability even if there's no one running against them.
Exactly. It ensures directors need to maintain majority support from shareholders.
Who are their auditors?
They've recommended Plante and Moran, PLLC, as their independent registered public accounting firm for 2024. Shareholders get to ratify that choice.
Right. And executive compensation.
Shareholders participate in an annual advisory, non-binding vote on executive compensation, the so-called say-on-pay vote.
Advisory meaning the board doesn't have to follow the result.
Correct. It's non-binding, but boards usually pay close attention to the outcome. KFS's board recommends holding this say-on-pay vote every year, which provides consistent shareholder feedback.
Okay. Now, it's important for you, the listener, to have the full context from the source material we reviewed.
Well,
The proxy documents do mention past involvement in certain legal or regulatory proceedings for some executives. We should probably mention those for completeness.
right. Transparency is key. The documents note Mr. Fitzgerald's prior directorship in a company that eventually underwent receivership.
Okay.
They mention Mr. Stillwell consented to an SEC administrative order some time ago, which involved civil penalties and a suspension, but importantly, all obligations related to that were fully discharged.
Right. Fully resolved.
Yes. Mr. Hansen had a prior role at a company that, after he left, later filed for bankruptcy. And Mr. Hannon served as a director in a company that was placed into bankruptcy.
Okay. So this information is provided in their filings as required, just to give a full background picture.
Exactly. Standard disclosure requirements for context.
Finally, what if a shareholder wants to get something on the ballot themselves? Like make a proposal.
There are specific rules and deadlines for that. For shareholders wishing to include proposals in the proxy statement for the next annual meeting, say for 2025, specific deadlines apply. For instance, the deadline for proposals under SEC Rule 14A8 for the 2025 meeting was noted as December 11th, 2024.
So you need to plan well in advance.
Absolutely. Those deadlines are crucial if you're looking to influence corporate decisions directly through shareholder proposals.
All right, let's try to bring it all together now. We've really navigated the unique landscape of Kingsway Financial Services.
It's definitely unique.
We've gone from their entrepreneurship through acquisition model, which acts as this really interesting bridge connecting retiring small business owners with ambitious entrepreneurs.
To their more stable, diversified, extended warranty segment, providing that crucial foundation.
Yeah, and we've seen their strategic acquisitions within KSX, their detailed approach to supporting the operators they bring in using that Kingsway business system.
And those recent pretty significant financial maneuvers, especially that big Trumpets debt repurchase that really cleaned up their capital structure and generated that nice gain.
Yeah, that was a standout move.
KFS really offers a truly fascinating example, I think, of a public company trying to institutionalize what has traditionally been a highly personalized private market activity, the search fund model. It's a compelling blend of like entrepreneurial spirit and corporate structure.
It really is. So as you, our listener, consider this distinctive company, maybe here's a final thought to mull over. What do you think is the biggest challenge for a company like Kingsway going forward? Is it consistently finding the right fat pitch businesses to acquire, especially in what's probably a competitive M&A market?
Finding the deals.
Or is the bigger challenge actually cultivating and retaining those exceptional entrepreneurs, those C candidate leaders identified by their scorecards, the people who are absolutely essential to leading those acquired businesses and creating that long-term value KFS is aiming for? Finding the business versus finding and keeping the leader.
That's a great question. Where's the bottleneck? Is it capital, deals, or talent? Something to definitely think about.
Yeah, someone to mull over as you continue your own deep dives into the world of unique business models and investment strategies.